Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I'm going to continue on with my next 100 trades. Nothing much exciting going on there, and we'll kind of get through that quickly because there's some other things I want to get to. I want to get into Mine the Trade. Now, I have been doing a series on your brain on trades, and I will pick up that if we have time this week, but at the last minute, I changed the presentation to know the nuances of your methodology, which is very important at this juncture, given the state of the market. Housekeeping, I do take requests. If there's something you want me to cover in this, davelandry.com/contact. If I can't fit it into this venue, I do a weekly show, usually on Thursdays, davelandry.com/webinar to sign up for that. Sign up even if the link is old, or check my homepage on Thursdays to see if there's a show happening, but usually every Thursday except if I'm traveling, such as the ChartCon coming up. DaveLandry.com/StockCharts if you want the slides for this presentation and all the other presentations combined, along with a lot of free stuff to keep you busy for a long, long time. Get to know me first before you spend any of your hard-earned cash. All right, let's talk about the mystery charts and the methodology in action. Lately, I've been talking about my next 100 trades. Somebody said, hey, you're just showing the winners. I was like, well, I show a loser every now and then, but there's a lot more to do with the winners, meaning active management, as opposed to losers. You just let yourself get stopped out and you move on. But anyway, so this is zero hindsight and warts and all. And lately, it's been kind of warts and all, but that's okay. And I'm going to flesh that out and quite a bit. Showing a representative sample. It's not every trade that I make, but I'm trying to keep it kind of close to what I'm doing in a trading service. At least lately, I may take these trades in more than one account. So lately, that's actually been going against me. And that'll make sense in just one second. Here's a mystery chart reveal. This was going to be my next trade, but it turned out that it wasn't. And I'll show you why in just one second. There are the parameters down there. 610, 475, and 745. And it was a pullback, also a cup and handle type of pattern. It bottomed out in here for quite a while, then it began to rally and pulls back. That's one pattern that I really like, especially when a stock consolidates for a long time like that, gets its act together. Nice thrust from lows, about 100% or so. Pulls back rather deeply, which is fine. Shake out some nervous Nellies. Entry there, stop down below, and then initial profit target is up there. So let's see what happened. Well, nothing. It continued to pull back. I did lower the entry on that. Unfortunately, yesterday, which would be Monday, September 26th, even though it came dangerously close to triggering, it did not trigger. And this is why you want to wait for entry. So when this happens, in other words, you don't get an entry, no capital is put into harm's way. So let's do an update on EMBC. This stock had taken off nicely, began to pull back. You can see there's the parameters down below. That was first introduced on August 12th. And we had a nice thrust. We followed by a pullback and a TKO type move. Entry was here, stop was down here. Initial profit target was up there. I did take profits a little early. Now, as I often preach, we bring the stop up to break even when that happens. What I did in this case was a little bit different. I just followed the stop in my trading service, which is right here at 28, and it's getting dangerously close to that stop. So I made a little money in the first half, even though I didn't quite hit that initial profit target, and I went ahead and just used a stop similar to what I recommended, or exactly as I recommended in the service, at least so far. Now, here's the tricky part about using a little discretion. In other words, not following the plan exactly. I do believe in, if you're given a gift horse, in this case, a one-day move fairly close to the original profit target, it's worth taking. The only problem is then you have a dilemma on following the rest of the plan. So in this case, it didn't work out so well, at least not yet, unless a miracle occurs. So that's one, you can kind of look at that as a mistake made on that one, that I felt like it was worth following along just to kind of mimic what's going on in the trading service. That's usually what I like to do, but I do a lot of times feel that it's important to be willing to take those partial profits a tiny bit early, especially if you have a really fast move on one day. And hopefully that makes sense. If not, we can flesh that out in a lot more detail later. Here's an update on Verve, V-E-R-V. There's the original setup, as you can see. And in this case, it did officially hit the initial profit target, so the stop goes to break even, and then you trail a stop higher on the remainder. And I did get stopped out on this one. So how am I doing? Well, meh, not so hot. Last week, you could see that I was slightly in the hole, and then this week, I'm actually further in the hole. Now, if EMC stops out, which it's likely to do, then I'll be completely flat and just waiting and waiting and waiting for the next setup. And I'll talk a little bit about waiting in just one second. Next week, ChartCon. Very excited. I'll be in Seattle for this. If you want to sign up, StockCharts.com/ChartCon for more information on that. I think it's going to be a really, really cool thing. With 14 of us, I believe, are going to be there. And I can't wait to meet a lot of the people. A lot of people already know, but a lot of people I can't wait to meet. And I think it's going to be a really great presentation. So looking forward to that, October 7th and 8th. All right, lately for Mind and Trade, I've been talking about your brain on trades, and if we have time, we'll get to that. If not, I'm going to pick it up in a couple of weeks. No show next week, by the way, because I'll be getting ready for ChartCon. Now, I thought it was important, as I said earlier, to talk about the nuances of a methodology. And remember that all methodologies have their own nuances. Now, I'm a big fan of trend following, and I'll explain why in 1 second. But if you're trading something that's reversion to the mean, or let's say you're selling options or something like that, well, that's one of those things that'll work until it don't. In other words, you might do really well for a long while, especially if you're doing something like selling options. You'll have a very brief but brilliant career. Eventually, you're going to get whacked really bad. So sometimes you're printing money, sometimes you're stressing out. A lot of times you're stressing out. And a lot of times, especially if you're trend following, you're going to be bored. Now, trend following has plenty of nuances, but it's the only way to make money, as I've said before. If you make money on a trade, it means you sold higher than you bought, okay? So from, let's say, you buy at A and sell at B, and B is higher than A, well, you caught a trend, and that's the only way to make money, is to catch a trend. So my feeling is, why not trade with the trend all the time and look to catch trends? Probably the number one thing about trend following is it is streaky. And I was in Dallas, I forget how many years ago. It's probably been over a decade. Peter Mothy invited me over, and he was part of an investment group over there. And he's a former money manager, and he works in the money management business. And anyway, he said, Dave, why don't you come talk to these guys about the merits of trend following? And I was staying at his place. And when I got home, he gave me a little constructive criticism. And one of the things he said, use the word streaky, because that makes it sound a little too elusive. And the more I thought about it afterwards, the more I thought, no, I'm going to continue to say it's streaky, because it is streaky. And that's just momentum trading and trend trading in general. The money tends to come in chunks. And here's the other downside to it. The occasional outlier is key. If somebody gets on the trading service and they say, hey, Dave, it's not for me. It's like, why is it not for you? Well, I didn't make any money. It's okay. Well, did you get CPE for 500% or ARLP for 300 or 400% or however that one's going to work out? No, but I got all those other stinkers you recommended. Well, as you'll see in 1 second, those outliers are really key. So if you take a look at the open portfolio, and my drawing is a little bit off, and it should be around this 1,000 and 16,000, you can see that one big outlier, ARLP, makes up the majority of the open profits. Without it, we'd almost be at a loss, or very close to a loss. Now, I don't publish official results for various reasons, and one is a little discretion goes a long way when it comes to trading. And I have a long-winded answer for that. I have a frequently asked question page on my service. You can go look at that. But what I do is make the archives, the raw archives, available, and you can go in and take a look at those. And then Obviously, as I've been saying quite a bit, with my next 100 trades, I'm going to be pulling those mostly from the trading service. So you will get a feel for those trades, however long it takes to get to 100. Right now, we haven't had a whole lot of trades lately, so it might take a while. But what's kind of interesting is I went in and grabbed the closed trades, and I got a little asterisk there. Now, again, this is hypothetical, followed mechanically based on every recommendation that I made. Just going back, I went back a couple of years and just grabbed some data to see what it would look like. And you could see there was a nice little chunk here. By a chunk, I mean big profits. And then it did work its way higher, but it really wasn't that impressive until I had a big old chunk right here. And then there was a lot of treading water. I'm going to talk a lot about that in just 1 second. Now, if you add in that mark-to-market chunk over here, okay, that would smooth out a little bit of that treading water and make that equity curve look a little bit better. But these are just the closed trades, and the reason I want to show you them is because that occasional big winner can make all the difference in the world. And that's one of the issues with trend following. If you miss a couple of big winners, then you're going to be negative possibly, or mediocre at best. And it's something that you just have to learn to live with. And that's the secret to trading, as I was going to get into this week, is making decisions and living with them. And then how do you live with those decisions? And that kind of all backed up into know the nuances of your methodology. And if you know the nuances of your methodology, it's much easier to live with those decisions. Not easy when you're going through a drawdown, but easier. Now, one thing about trend following is you will spend most of your time less wealthy. So we'll take a look at this Verve trade that just stopped out. You can see our entry was here around 26. First day of the trade, we're doing okay, up about a half a point, feeling pretty good. Next day, we're losing money. Now, we're making money once again, and after that peak, you could see we drew down for about a week or so, and then finally the market rallies again, we make a new equity high, and then what happens? Well, we go a long time, weeks, without making a new equity high. For one day, it's looking pretty good. We're making new equity highs, and then what happened after that? We go back to drawing down, and we stopped out. Now, at that peak, we were up 1936 on the remainder of the position based on a 100K account. And after getting stopped out, we only made 688. So we were less wealthy by 1248 if you're looking at that equity high. And that's a pretty substantial drawdown. Now, the reason I allow that to happen is sometimes the market will pull back and then take off again. And by using that liberal stop on the remainder, remember, we're free rolling, so to speak, because we already took partial profits on the position and we're trailing that stop higher. So we have the potential for a longer-term home run. At worst, barring overnight gaps, of course, we'll still make a little money on the trade, especially if we add in the initial profit target. So you end up $1,248 less wealthy if you were looking at that equity high. Now, so did you lose money or did you make money? Well, overall, you made $1,688 on the trade, because remember, we're going to take partial profits. When we are up 2% on the trade, we'll take off half, and on a hypothetical 100K, that would be $2,000. Half of that would be $1,000. The stop goes to break even, as I preach, and then we trail more loosely on the remainder. But yeah, it sucks, to put it frankly, giving up those open profits, but it comes with the territory. Dennis and Eckert, I think it was Richard Dennis, and this was based on what Curtis Faith wrote in his book about the Turtles experience. He said that Dennis was much easier, or really didn't have an issue with open profit drawdown as opposed to flat out open losses. If you should have been stopped out, you should have been stopped out. But he kind of saw the open profit drawdown as something that comes with the territory. And anytime a client has, they don't do it anymore because they know better, but anytime a client has ever complained about that open profit drawdown, I say, well, look, okay, you made $1,600 on a trade or however big your account is, multiply that out. Why don't you send me that money, keep out a couple $100 and get yourself a massage, send me that money, and then through the massage, get yourself centered, and then forget that trade ever happened. That way you don't have to worry about it. And in 20-something years of doing this, I've never received a check from anyone who was complaining about those open profit drawdowns. It just comes with the territory. It's one of those things. Now, here's the thing. It's going to end badly. And just like I showed you that Verve trade that had that drawdown before it stopped out, every trade is going to end badly. When you buy a pet, it's going to end badly. My wife was on the floor crying the other night because the dog had 3 seizures and it's not looking too good for the family pet. Now, here's the same person that was kind of fed up with the dog and sick of the dog, and then she's laying on the floor crying the other night. So, just a warning, if you buy a pet, it's going to end badly. I think most people who's ever had a dog or any other pet knows that. Now, my corollary to that is when you make a trade, it's going to end badly. It just comes with the territory. You're either going to get stopped out of a loss, or in the end, you're going to give up some open profits. So it's either going to be on the left side of this, where you just make a flat-out loss on the trade or take an absolute loss on the trade. You could actually hit the initial profit target and scratch out, and that's one of the secrets to the methodology, is just chip it away at it, lose a little, make a little, lose a little, make a little, until you get to that elusive, and there I said the word again, streaky, elusive outlier, where you make a whole bunch of money. But in the end, you give up a lot of money on the trade. Now, hopefully, a word you should never use in this business, but hopefully that ARLP does not stop out. It did get dangerously close to that stop yesterday, but hopefully it doesn't stop out. But if it does stop out, the open profit drawdowns are going to be absolutely substantial. And I'll show you those when they occur. So again, you buy a stock, you lose money. You buy a stock, it hits the initial profit target, and then you scratch out. At least you make a little bit on that trade. And then in this case, which is the ultimate goal, you buy a stock, it hits the initial profit target, and then in the end, you give up some of those open profits, just like we just did on Verve, although that one didn't turn into the mother of all winners. Now, you're going to be wrong a lot if you are following a true longer-term trend-following system. You're going to be wrong about 72% of the time. Many years ago, I did a lot of mechanical testing, and that's what turned me into a discretionary trader, meaning that now I just look at a lot of charts and I have a methodology where I'm looking for certain things in the chart, but it's not precisely a mechanical methodology. And I'm not a huge fan of mechanical stuff, and that's something we can get into at some point in time if you'd like to. But it did help me learn a lot. And I noticed that my longer-term trend-following systems that I was developing were only right about 28% of the time. And the turtles, and I hate to take anything away from them because what they did was nothing short of amazing, but I do think they were in the right place at the right time. And most of them, and again, I would never be schadenfreude in this business, but from what I've seen, most of them really haven't done that well since. Now, the thing about it, read Market Wizards if you want to learn about the turtles. Read the original one on that. And I swear I would never read these turtle books. And the reason is because there's certain individuals that were trying to capitalize on their success by writing a book about them. And I just had a bit of a problem with that. And then, as I've said before, Larry McMillan told me that when I said that to him, that I'm not going to read those turtle books, he says, well, you know, that one Curtis Faith wrote was pretty good. So I recommend you read that. And as I talked about a few weeks ago, I'd also read his book, Trading from the Gut. But anyway, getting back to the turtles, they were in the right place at the right time. And what happens is if you're doing a pure trend following approach, you're going to have abysmal percent correct And you're also going to have abysmal drawdowns. In fact, if you read Curtis Faith's book, you'll see that about halfway through the program, Dennis and Eckert were crunching the numbers, and they realized that at their leverage they were using, they were very close to possibly blowing up, and they immediately scaled back everything with what they're doing. Now, my way to compensate for the problems with the longer-term trend following, even though that's where the money is to take that partial profit off at a swing trade to get that stop to break even, and then change hats and switch into trend following mode, as I often preach when it comes to the money management. Now, you're also going to need extreme patience. You're either waiting for a setup to trigger, you're waiting for setups. Like right now, I can't find a setup to save my life, barely at least. We had that IBRX, it didn't trigger, so now we're back to trying to find setups again. Or you're waiting for the market to move, and again, once you find a setup, then you're waiting for it to trigger. You might wait a week or so and it doesn't trigger, and then you're just back, or you remain, I should say, in the waiting game. So the market doesn't move on your time frame, and it could be a revolving door with my trading service. I see people come in to give it a shot for a month, and in reality, they really need to look at it over 6 to 8 months to see how it does. And they probably should go in and look at the last 6 to 8 months instead of try for a month and then go off and do something else. I guess the worst thing can happen, though, would be they come in on a good month, do really well, and they always expect that to be that great. And that initial success, not to get sidetracked too far, imagine that, me getting sidetracked, but you got to be careful. If you have that initial success, sometimes it can go to your head. Now, getting back to the fact that you'll spend a lot of your times less wealthy, at the last minute I grabbed these slides from a presentation I did a while back, and it might be from Trading Full Circle, which is a course that I did. And one of my clients years ago was kind enough to send me this video on YouTube from Mr. Frey, and he pointed out that you spend 75% of your time in a state of regret or drawdown. Now, without backing up too much into the neurology of this, there is a very negative thing that happens. Negative observations and negative things such as losses can wear on you because they have twice the impact of a positive one. Greg Morris once said markets only make new highs 4% of the time. So most of the time you're waiting, and there's a lot of backing and filling. Now, the other thing is you must be present to win. And this poor one guy thinks I'm picking on him, but there's been quite a few throughout my career, especially with the public stuff that I've done. And he sent me an email one day, kind of like now, where I just can't find a setup to save my life. He goes, Dave, he goes, I'm not going to leave you. I'm going to stay on the service, but I'm going to just go ahead and take a little break from the service for a while because I don't see any setups, and I can't imagine there'll be any setups for the foreseeable future. And neither could I. But because I have a clientele, I continue to do my homework. And that night, literally a couple hours later, I found two of the biggest winners of the year. Now, I didn't email him and ask him, did he go on a vacation the next day or did he leave right away? Like, when did a break start? I'm afraid to do that. But unfortunately, you must be present to win, and you have to do your homework even when things aren't fantastic, and maybe especially when things aren't fantastic. Now, next week I want to pick up on is present Dave going to make future Dave mad? Getting back to your mind on trades, and there's a lot of things that you could do to help that from happening. You have to sort of time travel, so to speak, and you have to accept the trade going in and make sure you're picking the best and leaving the rest. And we're going to pick up this in future presentations. Again, if you need some follow-up information, davelandry.com/StockCharts. If you need to reach me, davelandry.com/contact. And if you want to join me on Thursdays for a live webinar, and these shows should be live again fairly soon. I know they have the studio built. I know they're anxious to get up and running again. I think ChartCon hopefully will be the beginning of that. But anyway, those shows have been live throughout. It's davelandry.com/webinar for that. I want to thank everybody for watching, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.